Hello, this is the new issue of Golden Way Business News. The gold market narrative has been driven by the contrasting effects of persistent high inflation and central banks raising interest rates in response. With the US dollar hitting a 20-year high, gold fell to a 3-month low on the 13th of May. The commodity rallied at the start of June, hitting the highest price levels it has seen since the 9th of May, but dipped in anticipation of a 75 basis point rate hike by the Federal Reserve. With the $1,700 an ounce range in sight, gold remains well below the $2,000 level seen in early March. Although a weaker US dollar is providing the commodity with some positive momentum, the fundamental reason for most analysts not having a longer-term bullish perspective on gold, rising US Treasury yields, remains intact. The gold market closed at $1,808.20 an ounce on the 13th of May, having dipped below the $1,800 mark for the first time since the 4th of February to $1,797.20. Gold tends to trade in an inverse direction to the US dollar as it becomes more expensive for buyers with other currencies and does not yield interest. The dollar has benefited from the uncertain macroeconomic environment, with concerns about high inflation, the prospect of recession, slowing growth in China, and the impact of the Russia-Ukraine war, prompting investors to sell other assets in favor of holding dollars. The US dollar index, DXY, which measures the performance of the dollar against a basket of other currencies, soared to 105.08 on the 13th of June, its highest level since late 2002. As the US 10-year bond yield broke above 3.25%, the DXY has since edged down to 103.93 as of the 27th of June. Gold, on the other hand, moved in the opposite direction on the 13th and the 14th of June, shedding 3% from 1,875.5 to 1,831.8 and 1,813.5 as traders braced for the Federal Reserve rate hike on the 15th of June. Gold had climbed to a high of $2,043.30 on the 8th of March, a rise of 13.5% from the $1,800 level seen at the start of the year, as the Russia-Ukraine war escalated. That was close to the all-time high in dollar terms seen in August 2020, above $2,070, and a new record in euro terms. The US Federal Reserve, Fed, has hiked interest rates 3 times so far in 2022. The Fed implemented a 25 basis point hike in mid-March, a 50 basis point increase on the 4th of May, and the 75 basis point rise on the 15th of June, its biggest rate increase since 1994. Economists polled by Reuters expected the Fed to lift rates further by 75 basis points in July and 50 basis points in September. These expectations have the potential to limit the upside for the gold market in the near future. A recession would be supportive to gold prices, but the sharp increase in interest rates being used to tackle inflation has so far been limited to the upside for the precious metal. The Group of Seven has recently decided to ban the purchase of newly minted and refined gold from Russia in the latest move by the US, Britain, and their allies to ramp up sanctions on Russia in response to its invasion of Ukraine. The market response to the move was fairly limited, as the gold industry had already imposed far-reaching restrictions on Russian gold. When considering gold price predictions for 2022, it's important to keep in mind that high market volatility makes it difficult to give long-term estimates. As such, analysts and algorithm-based forecasters can and do get their predictions wrong. We recommend that you always do your own research. Look at the latest market trends, news, technical and fundamental analysis, and expert opinion before making any investment decision. Keep in mind that past performance is no guarantee of future returns, and never invest money that you cannot afford to lose. Golden Way: think different, earn different.